Welcome to the Bull Strangle Strategy. Our approach combines stock ownership with systematic options selling to generate income while maintaining long-term market exposure. Every trade follows a repeatable process built around stock selection, premium collection, risk management, and disciplined execution. Let's get started. By now, we've narrowed roughly 5,000 optionable stocks down to a carefully selected watch list using objective screening criteria. We've eliminated companies reporting earnings, ranked each stock using 7 historical metrics, and built a diversified list of potential trades. Now comes the next decision. Which option should we actually sell? Many option traders immediately focus on delta or option premium. While both are important, there's another factor that often receives far less attention, and that's liquidity. A great stock doesn't always produce a great trade. If the option market is difficult to trade, poor execution can quietly reduce your returns over time. Today we'll look at why liquidity should be evaluated before choosing a strike price and how experienced traders think about option execution. What is liquidity? Liquidity simply refers to how easily an option can be bought or sold at a fair price. Healthy option markets generally have 3 characteristics: relatively tight bid-ask spreads, sufficient open interest, and active daily trading volume. Together, these factors improve price discovery and make it easier to execute trades near fair value. Poor liquidity creates the opposite environment. Bid-ask spreads widen, bills become less predictable, and you may find yourself repeatedly adjusting your limit order just to complete the trade. For a strategy that repeats every week, those small execution differences can become meaningful over hundreds of trades. Technically, the bid is the highest price a buyer is willing to pay, while the ask is the lowest price a seller is willing to accept. In practice, however, experienced option traders rarely expect to trade at either price. Instead, they view the bid and ask as boundaries of a negotiation. The goal isn't to sell at the bid or buy at the ask. The goal is to receive a fair fill somewhere within the spread using a limit order. In liquid options markets, those orders often fill quickly with little or no adjustment. As spreads widen, however, confidence begins to decline. You may have to lower your asking price several times before receiving a fill, gradually giving up premium along the way. That's why I think of the bid-ask spread as more than just a number. It's a measure of execution quality. This example illustrates how execution typically changes as liquidity deteriorates. Notice as the bid-ask spread widens, the expected fill price gradually declines. More importantly, your confidence in achieving that fill also decreases. With excellent liquidity, limit orders often fill immediately. With acceptable liquidity, you may make one adjustment. Marginal markets require several adjustments. And with poor liquidity, I've often found myself lowering my asking price 3 or 4 times before finally receiving a fill. At that point, I usually ask myself a simple question: why am I forcing this trade when there are plenty of other opportunities available? Sometimes the best trade is the one you simply skip. Execution quality doesn't just affect the price you receive. It can determine whether the trade still satisfies your investment criteria. Suppose my objective is to collect roughly 2% of the stock price in option premium for both the call and the put. If I'm trading a $80 stock, a few adjustments to my limit order may reduce the premium below that minimum objective. The trade still gets filled, but it no longer meets the rules that caused me to select it in the first place. Starting with roughly 3% option premium provides more premium cushion, allowing several adjustments while still satisfying the minimum income requirement. The lesson is that every trade should begin with enough cushion so that normal execution doesn't compromise the strategy. Finally, remember that liquidity is about more than just the bid-ask spread. I also look at open interest and daily trading volume because both provide additional clues about the health of the options market. Higher open interest generally means more market participants, and higher trading volume often leads to better price discovery and more reliable executions. Taken together with bid-ask spreads, these metrics provide a good picture of how efficiently an option trades. Throughout this series, we've followed the same philosophy: identify the highest quality opportunities and eliminate unnecessary risk whenever possible. Liquidity is simply another example of that philosophy in action. The goal isn't simply to get filled, it's to receive a fair fill that still meets your investment objectives. If an option market forces you to compromise those objectives, the better decision is often to move on to the next opportunity. In the next video, we'll build on this foundation by exploring strike selection and discuss how to balance premium collection with the probability of success. Before you go, continue your Bull Strangle journey. Visit bullstrangle.com to receive weekly stock selections, option selling opportunities, and ongoing research designed to help investors generate consistent income. For a complete step-by-step guide, pick up a copy of the Bull Strangle Strategy, which is available on Amazon. Research, discipline, consistency, income. Thanks for watching, and we'll see you next time.